Hi, I'm Kene Ezeji-Okoye, and this is Reinvent, the podcast about the future of money. Today I'll be joined by Chris Ostrowski, CEO and co-founder of Soda Public Money, a private organization driving the mass adoption of digital money by highlighting and implementing real-life use cases for stablecoins and CBDCs. Soda advocates that institutions in the current financial ecosystem should have access to the tools and resources they need to move from discussion to action and begin to explore the future of a more financially inclusive world powered by blockchain-based networks. Chris has a storied history at the intersection of digital technologies and monetary policy. Prior to launching Soda, he was Chief Revenue Officer at OMFIF, a world-leading independent think tank promoting global financial and monetary cooperation, where he also launched and served as the MD for the OMFIF Digital Monetary Institute. Chris also led public sector engagement for Celo, an open-source blockchain platform designed to increase financial inclusion by making it easier for people in underserved and unbanked communities to enter the financial system by making secure, scalable, and low-cost financial services available to anyone with a smartphone. Chris has also found time to serve as a visiting lecturer at IE Business School, act as the co-chair for the Digital Euro Association's Private Digital Euro Working Group, and feature as a keynote speaker at events and conferences around the world. I'll be speaking with Chris about real-world applications for digital currencies today on Reinvent.
Reinvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.
Chris, thanks so much for taking the time to join us here today.
Thank you, Kenny. Thank you for the welcome. It's a pleasure to be here.
So, Chris, given that this is the first episode of our series, would you be so kind as to lay out a quick foundation for our listeners and explain the differences between different types of digital currencies?
Certainly. And this is something which is sometimes disputed and contested, the way in which currencies are categorized. The way that I found it most useful to think about is to think about private digital currencies and crypto tokens as one form of digital money. So you've got cryptocurrencies, crypto tokens as private digital currencies, private money. Public digital money is any form of money which is denominated in a fiat currency, such as a digital pound, a digital euro, or a digital dollar, and which is token in nature. So it's blockchain based or something similar to that, which allows it to be a public currency in a new digital habitat. We currently have a form of digital engagement with money, which is really a form of e-money. And that, I would say, is different to private currencies and public digital money, because e-money is what we have now when you pay on your mobile phone or on the internet or on a bank card. And e-money is obviously grown as the payments industry has changed recently. Now, cutting across these currencies, there's wholesale, and there's retail. And we won't really go into that because we're mainly kind of talking about retail here. But there's obviously wholesale money and retail money when it comes to the banking sector as well. So that's how I tend to categorize it. And that's what I found most useful since I've been working in this space.
So would you place a privately issued stablecoin like, let's say, Circle's USDC into the public money bucket because it is fiat denominated?
I would, yes. That's how I've this is how we do it in the discussions that we have with central banks. That's broadly how most central banks have been able to engage with this. There is a difference between the Ethereum governance token, between a Bitcoin or any of the other crypto tokens where the value is purely based on sentiment, and those tokens where the value is based on a peg to a dollar or a pound. So I would describe that as a form of public digital money. As it's not regulated, I would say, if you wanted to be very precise, I would say it's a form of privately issued public digital money. But it is still public money because it's a dollar in value when you hold it.
Interesting. That's a very interesting taxonomy. And how do the central banks that you've been engaging with react to this form of privately issued public money?
I mean, while it remains unregulated and outside the sort of scope of banking regulation and so on, it is still not seen, it's certainly not seen as the same thing as commercial bank money. It's not seen as the same thing as cash. But many of the most interesting discussions that public institutions have do zero in on, tokenized bank deposits, where some form of token comes out of a bank deposit, which is in some way pegged to a fiat currency. And so as we think about it, even though these stablecoins at the moment, though they do represent a form of public money, are currently, risky because they can lose their peg, as we saw with the Terra Luna debacle last year, it is still the case that these instruments in the future could well serve an important part of how public money can act for society in the future.
Interesting. And I guess these privately issued stablecoins have kicked a lot of the central banks into the next gear, most notably Facebook's Libra/Diem project that really spooked, I would say, the central banks, given that they had a user base bigger than the largest countries in the world. And today we've got over 100 central banks around the world representing 95% of global GDP working on a central bank digital currency, a CBDC, in some capacity. You started working on this in 2017. I imagine at that time it sounded impossible or implausible that this many central banks would be working on this problem. Can you walk us a bit through your journey from 2017 to today and tell us about the motivations and the path that central banks have and other institutions have taken towards the adoption of digital currencies?
Certainly. One of the things about the journey since 2017 has been that there is a before and after moment, and I think that line in the sand is certainly the Facebook Libra announcement, when David Marcus and Mark Zuckerberg said that they were going to have a Facebook currency that was going to be based on a kind of blockchain. It was, whether it was permissioned or permissionless, they were discussing that, and it was going to be based on a basket linked to the special drawing rights. That was the thing that really changed things from the before and after, because the thing is, that's possible. That can be done. The technology exists. It's not beyond the reach of what is technologically possible, or even from a retail distribution point of view, that it can be achieved. And for the first time, I think probably in the history of central banking, central banks suddenly realized that this could be an existential crisis. You could simply stop using any domestic currency, and the central bank could do nothing about it if people simply chose to use that. And so that was the before and after moment. I think as we look back to the other events, I mean, also in 2019, the fear of crypto in some countries, particularly when Bitcoin became more widely used in some emerging market countries, some central banks and central bank governors started to realize that they wouldn't have the policy levers they thought they had if they wanted to suddenly introduce capital controls or devalue their currency. If people simply weren't using it, and if that trend grew, then this would mean that the central bank wouldn't be able to intervene and act in a way that would benefit the population, or that we would be able to serve the central bank's policy objectives. So certainly the fear of crypto in some countries was a motivation. The other thing was competition. I mean, China also in 2019 announced publicly about its yuan pilot. And, one of the kind of geopolitical folk in Washington-based think tanks started writing articles about the renminbi turning into a digital instrument and replacing the dollar as the world reserve currency. Now, there are many reasons why that probably wouldn't happen, and many other things have to happen for the dollar to stop being the world's reserve currency. It's not simply this. But the fact that that was announced publicly, and the trial was to be announced, was to take place at the Winter Olympics at the beginning of 2021, that public announcement also triggered people. So it was a combination of the fear of crypto, competition from other countries, and also, I suppose, a growing recognition that some of the token-based changes in technology, what you might call the Web3 changes, and decentralized technology, could serve money in a way that was quite innovative. And so there was a genuine interest in technological changes as well as, the fear of competition and the fear of crypto. So it certainly went from being pre-2019 a kind of quirky thing that some central banks said they would never be interested in, didn't want anything to do with it. Bitcoin was seen as a bit of a joke, to changing quite quickly and accelerating into a place where this is a reality. It could happen. If Amazon or Facebook wanted to launch their own currency, this would change things immeasurably and change things in a way which would be unrecognizable. And central banks' response to that has included looking at new technology on the wholesale side, on the retail side, and at various other decentralized technologies that can serve wholesale and retail currencies.
Interesting. And let's touch quickly on some of the benefits that you mentioned there of this Web3 technology. How is it better than the e-money that we have today?
Sure, and that's the absolutely best question. I mean, because if you can't show what it does that's different, then there's no point. Because e-money payments, the payments industry has advanced remarkably in the past 5 years. The Google Pay, Apple Pay, the things you can do with these wallet-based technologies are remarkable. And so there's a lot, and some of that is being them recognizing the kind of threat, I suppose, or the changes that are kind of over the hill when it comes to crypto. But in terms of the actual differences, I mean, in emerging market economies, the benefit is actually quite clear and obvious. I mean, you can send a remittance from one country to another for free almost, or for 1% of 1 cent immediately, and it can land in the hand of your person immediately, and they can then spend that token in the local grocery store and buy something immediately. And so the transmission and the atomic settlement massively empowers people who don't have a bank account, or who have a bank account but don't have access to financial services. Again, some of these token-based sort of public money instruments can do all sorts of things that you simply cannot do with e-money. If you are a small fisherman, you can have a form of micro-insurance that insures your boat in a way that, for very good reasons, the current financial system will never offer you insurance. Small landholders, small whole farmers, those types of individuals who are economically vulnerable will be able to do far more with the money they do have than they can do now. If you have to do everything in cash, it's very difficult to maximize your income, with remotely. If you grow if you're a small holder and you grow food to send the food, I mean, the sending bit is actually the easy bit. It's sending the money and having some sort of agreed payment mechanism. You tend to have to go through a bank or a trade finance actor to do that. This puts the sort of economic development and prosperity out of the reach often of the end individual. With a token-based form of money, you can write that contract into the token. And this is absolutely revolutionary. So certainly for dispersing aid in cash in emergency situations, micro-insurance, remittances, the sorts of you can have a credit rating for the first time, you can have yield, have a yield product on a digital version of cash for the first time without having to have a bank account. Those are the types of things that will make an enormous difference to some of the most economically vulnerable people in the global south and in emerging markets. So that's quite inspiring. And people do kind of get that, because you can, all of those things I just mentioned, you can already do with crypto. Okay. And there are, it's not very widely used. Obviously, the annoying thing is that the crypto token, if you're actually using the token and not a stablecoin, goes up and down anyway. So you don't want to pay for your insurance in something that's, so all of those problems exist because it's crypto. But if it was a form of stablecoin, regulated stablecoin, or a CBDC, then you could really see things changing in a way that, is never going to happen under the current system. So that's quite inspiring in emerging market economies. When it comes to non-emerging market economies, when it comes to the global north, Western Europe, North America, and so on, the argument's different, because you can do many of those things. You do have access to insurance, and you can, the banks are being forced to reduce prices in how much you can send money. So even though it's you could save some money, there's an obvious big win. I would say there's no kind of hair on fire moment here. This isn't the kind of thing where this is what you need to do to solve this problem in your life. It's more like the transition from sort of videos to DVDs to Netflix subscription. That's kind of more where it is, where people thought that going from video to a DVD was the best thing ever. End of VCR, DVDs are perfect. You can't improve this. And then 10 years later, no one even has a DVD player because things have changed. There are a couple of ways of looking at this when you're considering non-emerging market countries. One is the cost of payments is still quite high, even though it's hidden. So if I give someone cash in a shop and they give me a product, I'm actually subsidizing the cost that is used for everyone who uses e-money. So if I pay for that item with my card, it goes from me to my bank account to the card provider to the other card provider to one of the merchant actors back to the individual's bank account. Whereas it could, and so even though we don't notice that when we pay for these things, the reduction of that will make some sort of economic difference. But that also, I accept, is not a big sort of win right now. It's a kind of hidden benefit that will come with this. The other ways to look at it is there are some things that tokens can do which really are quite innovative. I mean, a few examples here. One is the kind of micropayments side of things. You can write into a token that, if you put a YouTube video, if you upload a YouTube video, you could get a penny for every time if someone watches that. So you can kind of monetize your artistic work in a way which is very difficult to do with the current e-money sort of banking card web payment system. It's too expensive, it's too clunky, it's not agile enough to do that. Similarly, reading an article in the Financial Times, you could pay 80 pence to read the article and not have to buy the subscription. Again, or very, very difficult to see how you can do that without the kind of token-based public money that I'm talking about. A couple of other things as well. More excitingly, the machine-to-machine payments. So, if I turn that light on behind me, when I switch it on, the electricity company could take money from the token-based from the token that I'm holding for the period I've got the light on, and then stop taking it when I switch the light off. So an API that's built in such a way into a smart contract that you only pay for the electricity that you're using there and then allows a kind of a form of tokenized supply chain that allows any electricity generator to benefit when you're using it, even if they have their own solar panels or anything like that. And similarly, if you can tokenize the whole supply chain, then you really do change the business model. If the moment that you buy a glass of wine in a cafe in London, the actual owner of the vineyard gets paid the moment you buy it, then you allow that merchant, the vineyard owner or the wholesaler, to have access to an entirely new sort of set of market and new actors to enter. So you're actually talking about a real change in the business model where producers are not so dependent on how on the financing of getting goods from A to B, if you can tokenize the value itself. Now that's quite a kind of complex way in a way, but there are some examples there of how you can see how it will transition from a kind of analog system of finance where there are quite long delays and there's a lot of the counterparty risk is always held by the smallest party at the moment. That wouldn't happen once you tokenize the entire value chain or represented value in token form, not just with money but with the product as well. So that's kind of what we're looking at. Now it takes a bit of time to get your head around this, and it's a little bit difficult to explain sometimes. So I tend to start with the more simple examples. Emerging market countries, it's clear. In developed markets, there's also some examples such as the micropayments or the machine-to-machine payments that also make some sense. But it's a different type of discussion there, and I think it's important to make sure that we keep the use cases both inspiring but also within reach and practical.
Mm-hmm. That's well said. There's a lot to unpack there. I think that in the developed markets, one of my favorite use cases is the micropayments. Newspaper paywalls really annoy me, and we've been forced by the cost of using cards or Apple Pay or Google Pay into this all or nothing subscription economy. Whereas, 20 years ago, I could go buy my newspaper for 50p and get a single newspaper and not have to subscribe. I'm now forced into this all or nothing model because the cost doesn't work out. In the emerging markets, I think you're right that the use cases are much more clear and much more urgent than they are necessarily in the more developed markets. And that it is, I liked your VHS, DVD, Netflix analogy. And for some of the emerging markets, it's like leapfrogging from even 16mm film or VHS all the way to Netflix, skipping DVDs.
Yeah.
Whereas the developed world is still in a DVD area. We're not on the Netflix yet. But despite a lot of these emerging market economies being the first to actually put CBDCs in the wild, and the use cases that you've brought up, we haven't seen that much adoption outside of China, which appears to be doing quite well. But for Nigeria, for example, only 0.5% of Nigerians have ever touched the e-naira. The government is cracking down on cash usage by restricting the amount of cash that people are allowed to take out of ATMs or a bank. So why is the adoption not what you would imagine it to be if it's got all the benefits that it does?
Yes, I mean, again, thank you for that question. I mean, this is quite a bit to unpack there. I mean, I'm always fascinated to learn more about China because I find it very difficult to kind of get into the details of how widely it is being used. I mean, I'm not convinced that the Chinese experiment pilot launch has been that widely adopted either. And that's more based on simply people who I know who are Chinese who go home and, show me the wallet when they get back. There is some data that shows that it is being used, but I mean, it as is often the case, with these things, well, there'll be a lot of bumps in the road. If it's a new form of money, as with all things, there probably will have to be some sort of incentive. So the Chinese, the People's Bank of China had an incentive system. They had a lottery system. There was a bit of free spending money for people who went to the Winter Olympics. And in Nigeria as well, they've given a lot of incentives. They've basically gone to the merchants and offered a lower fee than what some of the card providers offer, which is, I suppose you could argue, is a good thing for a government to reduce the cost for merchants. But it's not really sustainable if you look at this. I mean, so simply offering, I mean, this will have to happen at the adoption phase. But if you're simply, if adoption is, if it's a central bank's job to drive adoption or the government's job to drive adoption, then there are going to be those sorts of incentives. So it would be far better to have organic new experiences where people find that money works better for them in this form than it does in cash form or than it does in commercial bank e-money form. And that's the trick, really. What can we do to show that this form of money works better for people? One of the dilemmas that central banks face, and I do have a lot of sympathy here for policymakers, is, I mean, to make the token-based form of public money as agile and as innovative as possible, with as many use cases as possible, you do have to make it as open as possible. And this is something that often central banks are kind of hardwired not to do. To create a digital token that they simply push out there into a multi-blockchain, multi-validation environment is not something that central banks are just going to wake up one day and decide to do. So if you kind of row back from that and you say, oh, well, we'll have a private blockchain, or we'll actually just have a database, we'll issue a kind of form of token on the database like the e-naira, then if that token doesn't do anything different to what e-money does, then it ends up looking like e-money and sounding like e-money and doing all the things that e-money can do. And then if you do have a bank, if you're lucky enough to have a bank account or you use M-Pesa or one of the e-money providers, you think, well, this is just the same. Where's my micro insurance? Where's my free remittances? Where's my aid work? Where's the other things that I was talking about, like the credit ratings, and where's my access to lend and borrow money in a tokenized way? And if it doesn't offer those things, why would you use it? So central banks, I think, are taking an interesting approach. I mean, the discussion is not yet settled. I mean, if a central bank says we do not want to have any distributed ledger or blockchain-based system at all, but we do want to have a CBDC, then I think they will continue to struggle, because if there's no blockchain-based system or there's no distributed ledger at all, public or private, then I think you're going to end up with a situation where people just don't see it as being any different. Some of the more interesting experimentation is from central banks who said, well, okay, let's issue a digital instrument, try and take the value out of it, but just issue a digital instrument which is totally open, that can be on a blockchain that's validated in a proof of stake or proof of work manner, and let's see how that behaves. And so then central banks, I suppose, come into contact with the trust issues that matter. It's really important that this gets right, because certainly I wouldn't actually be in favour of any country putting their CBDC on an open permissionless blockchain right now. But I do think we need to acknowledge that the benefits that come with this tokenized form of money are found there, and are found less so when a token simply issued on a private database. You also spoke about cash. I would advocate cash remaining in robust form forever. One of the most interesting questions I ask central bankers, and they often give a different answer in public to in private, is if you could have your time again now, would you create cash? And most of them in private say no, they wouldn't actually, because what they've done is they've created these notes and coins that they've pushed out. They don't know where they are, they don't know who's got them, they don't know what's happening to them. If you burn £10,000 in your garden, there's no one in the Bank of England going, minus 10,000 on the ledger. So they don't know how much is out there. They don't know where it is. There's nominations. There's just too much. And so we're kind of asking them to take that bold step again, but in a digital habitat, right? Do cash again that you probably wouldn't do because it's a bit of a nightmare for you, but do it again into a digital habitat, and then let the agility of the tokens, bring the use cases into the money. So it's like cash, but it just works better for people. And that's a really difficult thing to do. So at this stage, we're still talking about central banks wanting enough control over the habitat before they do this. And that's the balance. If you have too much control, you don't have the use cases, people don't use it. It's a bit too early for central banks to really push out a form of new money in a habitat that's so unfamiliar to them.
So that's really interesting, Chris. You touched on a couple of points there, namely control and trust, that tie into the perception of a lot of members of the public, maybe not a lot of members, but the loudest members, let's say, on a platform like Twitter, who are anti-CBDC because they see it as a way that the government could control them, could control citizens. You can't have too many hamburgers, or you haven't been eco-friendly enough, so you can't travel. A kind of social credit system, or leading down a road to Orwellian control. And do you think that a lack of trust in governments and in central banks, which was the impetus for crypto to start in the first place, is hampering the adoption of CBDCs? Or is that a fringe group that just speaks loudly?
Yeah, look, there's the crypto pioneers have strong feelings about this, and they express their feelings in quite vehement terms. But the nature of that discussion is quite unhelpful, really, because it sounds like what we want to do is tear down government institutions. Let's bring the dollar to an end. Let's bring the pound to an end. And this is not really very helpful, because outside of that fringe crypto sphere, people trust the dollar. They like the dollar. They use the dollar. The dollar has done an immense amount of good for humanity because it's a form of trusted currency that has allowed economic development. It's allowed trust. It's, the reason why it's the world's reserve currency is because individuals of their own free will in all sorts of different countries have chosen to use it for invoicing. And there are obviously, geopolitical hegemonic issues at play here as well. I think we obviously can't deny that. But this is what the dollar has done. So I don't think people don't hate the dollar or hate the pound or hate their own. There are some countries, obviously, where the currency itself is bad money for a variety of reasons. There's hyperinflation, or there's dollarization, or there's all those sorts of things. And that won't change just because it becomes a digital currency. There is still bad money in some countries. So I think people like the idea of the dollar. The current sort of system, most people don't really distinguish between cash in their pocket and the cash in their and the commercial bank money in their Google Pay account on their phone. So from that point of view, people don't actually know there's a difference anyway, even though those of us who study this or who work in this sector know there's a big difference between commercial money and cash. So from that point of view, people like the dollar in whatever form it's in, e-money, commercial bank money, or cash. And I don't think that's going to change. So we want to take the good things of the dollar, the good things of public money, of cash and of commercial money, and put them into this habitat, where crypto tokens have shown they can do so many more things, so many more empowering things for people. And this is where you're kind of trying to bring two very different worlds together. And this is why the kind of aggressive rhetoric on Twitter is quite unhelpful, I think, and I would like to see that come to an end. I mean, your point about government control is a good one and a valid one, and that's one of the reasons why I said that cash should exist forever, because there is a form of anonymity and a form of freedom, I suppose, that could exist which is delivered with cash. But the thing is that the levels of freedom that people, particularly who in more developed markets, think they have, is not a reality. If you are someone who literally uses cash for everything, then granted, if you have a big safe deposit box in your house and you only use cash, then granted you are beyond the reach of surveillance. But if you use your Apple Pay wallet or your Google Pay wallet or simply your bank card, or you transfer money on your internet banking, then what you were describing, the government can do right now. They can stop you buying train tickets to travel to a protest. They can stop you buying cigarettes right now. I mean, that degree of intervention can already be activated by a government right now. And so simply creating a token form of fiat money won't change the fact that can be done before or after. Whether a government does that or not is a serious matter, and democratic controls in democratic countries matter a great deal. I think that probably the sort of China example is probably one of the reasons why the anti-CBDC crowd are quite animated by this, because if you're not used to there being any individual privacy anyway, then people being able to watch every transaction that you do, whether you do it with a bank or with a CBDC, will continue. And I think we don't want it to turn into a dystopia. I mean, there is a danger the other side though as well, and this is what I often say to the crypto pioneers. I mean, if you did get rid of all of the dollar and you started getting rid of public institutions, then those public institutions that guarantee our freedom would also be damaged. I mean, the problem is that the pro-crypto community have become very loud at a point when there is a lot of skepticism towards the democratic, equal under the law form of democracy and society that we have. And so if you do get rid of the central bank, then because you don't need public money, do you get rid of law courts because you could just have a DAO where you vote on it? Do you get rid of Congress or Parliament because you could have a proof of stake voting mechanism? And then those public institutions that we rely on for our freedom, that free us, don't enslave us, will simply be replaced by a form of technology that I think would give us far less freedom, and it is far more frightening. So in both directions, government control and the sort of demolition of government institutions, there is a route to a dystopia. And I see it on both sides here, actually. So we just need to be careful here about how this is sort of discussed and played out.
I think that for me, being Canadian originally, the example that comes up a lot that actually hits home is Justin Trudeau, Canada's Prime Minister, blocking the commercial bank accounts as well as the centralized Bitcoin accounts of the Freedom Truckers.
Right.
And Bitcoin maximalists point to this a lot as a reason why we need sovereign offline money. But as you say, we already have that. We have cash. So Bitcoin, I suppose, could be used. It's easier to carry $10,000 worth of Bitcoin than it is $10,000 worth of cash. But I do think that you're right. We need to be careful because there's a dystopia on either side of this argument. and we need to find the happy middle.
Yeah.
Now, earlier in that, you spoke a lot about the dollar and dollarization. And today on public blockchains, about 99.5% of stablecoins are pegged to the US dollar. And we're seeing some of these emerging real-world use cases like the UN partnering with the Stellar Foundation to send international aid to the Ukraine in the form of USDC, a US dollar stablecoin. So what benefits or risks does this technology pose to the balance of power in international currencies?
Yeah, I mean, very good question. I mean, I think when it comes to stable coins, there are the best use cases are, you spoke about the ones on Stellar with the Stellar stable coin, but also Celo has done this with Hope for Haiti and with the UN World Food Programme and with the Grameen Foundation in the Philippines. I mean, the aid projects where people who previously received cash then receive a Celo stablecoin are really cool, because this makes a big difference to people's lives, and none of them ever want to go back to cash again, because you can do so much more with it. They can get it immediately, they can transfer it, they can share it, they can save it, they can get a credit rating. It's just so empowering and really cool when you see how stable coins are used to that effect. Now, these stable coins are not yet regulated, and the way how stable they are is a personal choice or a choice based on the sort of community, the Celo community in the case of Celo, in terms of how it's pegged. And as we have seen, there are pegging accidents when it comes to matching a stable coin to the dollar. And so even the
Celo stable coin is never depegged, though. Am I correct in saying that?
No. I mean, but this is because it's run mainly for these purposes. It's run as Celo's mission, as you said in your kind introduction, is really about poverty alleviation and financial empowerment for people who do not yet have it. And so it would be a complete disaster if the UN and Celo did a program and then the dollars that were being given to the recipients then devalued. I mean, that would just be the end of the whole thing. So the mechanisms are put in place to make that almost impossible, or as unlikely as it could ever possibly be. Now, obviously, if you're using a stable coin as a kind of earn products like the Anchor or Earn or all these sorts of things. I mean, the Earn's not a good example because that wasn't decentralized or stablecoin based, but you get the idea. Then once a depeg event happens, then you're in real trouble, And so as we saw with Terra Luna. So I think though the kind of how stablecoins can be used for payments and for these purposes are really cool and interesting examples, the reason why most stablecoins are in dollars are actually nothing to do with that. The reason why most stablecoins are in dollars is because that represents kind of 1% of what stablecoins actually do. 99% of what stablecoins do is they're on exchanges acting as a pair. So people who like to go onto centralized exchanges and trade in crypto, it's never been my thing, but if you want to, swap your Bit for your Ether, for your Dogecoin, for your AVX or whatever, then you can do that all day long. But like most FX trading in the fiat world, having a 1 is important, and the 1 is normally the dollar, and the stablecoin acts as a 1. So you might put if you're going from Dogecoin to Bitcoin, you might put $500 worth of Bitcoin into a stablecoin, Tether or the Binance's own stablecoin if you're on Binance or something else, and then put it into Dogecoin a bit later, and you might keep a kind of slush fund of the stables going on the exchange for a while. And that's what the most stable coins exist for, that purpose and in that way. And so that's why it's the dollar, because the dollar is crypto traders who want to swap between one coin and another also need a 1. If there was a dollar CBDC, then that would be the end of those stable coins, and you would simply put the token based dollar as your sort of holding account instead. Until that exists, then that's what the stable coins are for. And so that's the reason why, that's what most stable coins are used for, and therefore as a corollary of that, that's the reason why the most stable coins are in dollars. The more you get of that kind of 1% examples, the more kind of digital euros you can get for Ukrainian refugees, or use a stable coin to distribute aid to Afghanistan, the more you might see stables being pegged to other currencies in a way which has real life use cases. It's nothing to do with crypto trading, but that's just not big enough at the moment, even though it's an area that central banks are very interested in.
Interesting. Yeah, one of my questions when I saw the announcement from the UN about the aid to Ukrainians was, if Circle has launched a digital euro, which they have, is why didn't they use that coin? But it's interesting to also hear about the other programs that Celo has done, Help for Haiti, etc. I know that they've also got a euro stable coin as well as a Brazilian real stable coin.
Yep.
So all quite interesting, and trying to expand that 1% of real world use cases is, key to unlocking the real utility for everyday people. Now, we've talked about Celo, we've talked about Stellar, we've talked about CBDCs, we've talked about ETH. There are a lot of different standards across the industry. We've got public, we've got private, we've got, I don't know how many different layer 1 blockchains at the moment. Now, currently, one of the big problems in sending money around the world is the need for this correspondent banking system, because we don't have a global standard. We've got these economic islands all over the world, and SWIFT, although people think SWIFT moves money, really it's just a messaging system so that the banking system in country A can understand the banking system in country B, and they can pass messages to each other about how much money to send around. Now, are we in danger of recreating this system with the digital islands, let's say, isolated from one another, because all these technologies aren't really able to talk to each other very well, and there are so many of them that people are adopting one over the other for a number of different reasons? I know that Soda is very keen on getting ahead of this issue, and I'd like to hear about what you are doing and what the engagement's been like.
Thank you. Yes, I mean, CBDC is only one of the areas where a lack of interoperability is affected. So, if you look at Ghana and Nigeria, they've both launched CBDCs. They can't, even though it's, if anything, harder to swap one CBDC with the other CBDC between Ghana and Nigeria than it would be to swap one naira with one I forgot what Ghanaian currency is called now, Cedi, with to swap a Cedi for a naira in commercial banking terms is actually easier than swapping the two CBDCs. And that there's a lot of, central banks are often ask me, look, what are we going to do about this? We have technology providers who tell us that their technology is the best, that the most interoperable, that it can work across systems. But it seems when we look at our banks, at our commercial banks, those that have tried to, create digital assets or to sort of, tokenize various financial instruments, find that they are kind of siloed on a particular blockchain. So if an asset manager or a bank, decides to tokenize a particular asset class so that they can transfer them atomically with another bank or with another actor in the financial value chain, then even though this is kind of wholesale, it's still not very helpful if those assets simply remain siloed on a single technology, on a single blockchain. And many of these are actually not kind of public crypto type blockchains. They're private chains where you've got a form of distributed ledger, but it's not necessarily an open chain. It might be more like a database. But in any case, those the clients, the people who are starting to see how tokenizing digital assets can work, then find that they're not able to access other financial institutions who have tokenized their assets on a different chain. They're not able to communicate with the other banks who they need to communicate with to kind of get the level of liquidity in tokenized assets at the level that it needs to be. And so many central banks have spoken about this, but also the layer one chains themselves and others have also said, well, look, what can we do? Some sort of swift mechanism for banks is possibly what's required, but we also just need to come together and decide what we want from this and whether this really is worthwhile. Do we foresee a future where public money such as CBDCs and other forms of tokenized assets and cryptocurrencies that will remain out there can actually be exchanged between different actors and on different technologies in the future? Because if we want to see that, then we have to find some agreement of a form of minimum standard, or at least a minimum approach where people accept that this is okay. So you can go from an Ethereum-based chain to a private chain like Corda's R3 chain, R3 Corda's chain. And so that's the type of thing that you're kind of looking for. The use cases might drive this if enough sort of stock exchanges or bond traders decide to tokenize bonds, then they might just demand a standard themselves. But you've still got a large ecosystem outside of that, where you've got a form of retail-based tokens that are not talking. And until we get to a proper level of interoperability, the liquidity will always be kind of stuck. I mean, in summary, the two big issues that I see that are preventing digital adoption at the moment are the real life use cases that we've spoken about, but also this interoperability. So we have an interoperability group of the sort of 12 largest layer 1 blockchains and a few other actors such as regulators who we're meeting next week. That will be the first meeting, and we'll continue meeting. And the idea of that is at the end of a kind of a very informal process, we can find a way of forming a group that allows people to sign up to a industry-owned and industry-driven form of interoperability.
Very interesting. So I guess we're running right up to the end of our time. Try and keep this show around 45 minutes, but it's been so interesting. I haven't really looked at the time until right now. Let's close out with a couple of questions. Where do you see the digital currency industry in 2030?
I think one of the most interesting quotes I heard was that people always overestimate the amount of change that's going to happen in 2 years, but they underestimate the amount of time that's going to happen in 10 years. And so 2030 puts us 7 years out, so closer to the 10-year mark. I do think that there will be a far more widely accepted and used form of token-based money, including token-based public money, whether it's regulated stablecoins or CBDCs or a combination. I do expect that to be the reality in 2030, with use cases that people can see the benefit of in emerging market countries and in developed market countries. So I do expect that to be the reality in 2030.
Great. Well, let's end on that note, Chris. Thanks for joining us. I'll be sure to link some of your thought leadership pieces down in the show notes. Is there anything else that you'd like to point our listeners to?
Not at all. I mean, we've got, if you go to www.sodapublicmoney.org, you can see the use cases that we've got online. We've got new central banks we're announcing projects for us in the next few weeks, and other CBDCs. And you can also read the research from my colleague John Kiff on that as well.
Brilliant. Thanks so much for joining us today. Really excited about what Soda's working on, pushing for these real world use cases to get the benefits into the hands of people that need them the most. I think that the technology is fantastic. We are really at the beginning of this journey, and that a lot of good is going to be done for a lot of people. And thank you for being one of the people to push it forward.
Thank you, Kene. Thank you for inviting me on this show. I look forward to listening to it and to hearing from listeners. Thank you.
Reinvent is brought to you by Millicent Labs, building the financial infrastructure of tomorrow, where the power of Web3 meets the simplicity of fiat. Learn more at millicent.io.